Hi everyone. Good evening to everyone, and thank you for joining us. So, on behalf of Bajaj Finance Limited, I welcome you all to today's exclusive webinar session conducted by Bajaj Finance Limited. As always, it's our endeavor to bring you the latest knowledge and the updates from the mutual fund industries with the industry experts sharing their insights to help all our investors. So today we are pleased to have with us Mr. Shridatta Bhandwaldar, Head of Equities at Canara Robeco AMC, who is going to discuss today about the equity market outlook. So Mr. Shridatta, welcome to today's session.
Thank you, Abhishek. Good evening, everyone. And thanks, Bajaj Finance, for this opportunity to have an interaction with a wide set of investors and customers that you have. Thank you.
Right. Sure. So the audience, before we begin the session, let me introduce Mr. Shridatta with all of you. So, Mr. Shridatta, he is the head of equities at Canara Robeco Asset Management Company, and he has been associated with Canara Robeco since July 2016. If I little bit talk about the education and work experience about him, so he is a management graduate specializing in finance domain from Sydenham Institute of Management and has a rich experience of all about 18 years in Indian equities only. And prior to joining Canara Robeco, he was associated with SBI Pension Fund, Motilal Oswal Securities, Heritage Capital, and MF Global. If I talk about his roles and responsibility, the overall exposure he is having at Canara Robeco, so Mr. Sridatta forms an integral part of equity fund management team, and he believes in holding selective qualitative stocks only in the portfolio, which will help to create a wealth through compounding over a period of time. He manages an approximate AUM of 1 lakh crore and is the primary fund manager of the well-known fund schemes like Canara Robeco Equity Blue Chip Funds, Flexi Cap Funds, Focused Equity Funds, Canara Robeco Multi Cap Fund. Not only this, he is the co-fund manager for the multiple other well-known funds from the Canara Robeco AMC, that is Canara Robeco Emerging Equity Fund, Infrastructure Fund, Consumer Trend Fund, Canara Robeco Small Cap Fund, ENSS Tax Saver Fund, Manufacturing Fund, Mid Cap Fund, and in the last, Canara Robeco Equity Hybrid Fund. So today, with all of his expertise and knowledge, I'm sure the audience is going to be beneficial and will be able to take informed decision. So before moving to this, Mr. Sridhar, just let me have a brief about today's market scenario, brief on behalf of all the investors. So, as we take a look at today's equity market outlook, we find ourselves navigating a dynamic landscape shaped by both global and domestic factors. So, in other words, in simple words, we can say that we are seeing a mix of challenges and opportunities. The market is influenced by various factors, including economic trends, central bank policies, ongoing geopolitical uncertainties, and global events that are affecting investors' confidence. Because of this, investors are facing a challenging but yes, potentially rewarding environment in this time. And the best thing I would like to say that this is the first time I have noticed that uh, uh, in the market downfall side, when the market is at the downfall side, the investors are not about to booking the profit and getting exit from the market. Even rather as we are getting a n number of queries and people are approaching to the experts, their financial advisor, to for the better solution that what exactly they want to do and they should continue with the current market or they should rebalance the portfolio. What exactly the next step should be there? So according to financial advisor only, not for them. So, the audience in today's session, we will discuss about the key market trends, potential risks, and opportunities in the short term, medium term. So today, Mr. Sridhatta will share a comprehensive view and insights into what these changes means for the investors and what to expect in the coming weeks. So, Mr. Sridhatta, the stage is yours. I will not take much of your time. So now, stage is yours. Thank you.
Thanks, Abhishek. Thanks for the kind introduction of mine as well as my organization. Good evening, everyone. Let us actually use next 30 minutes to discuss various aspects. And clearly, as Abhishek said, this is a market where there are challenges and there are opportunities. And one thing that I have learned over the last 18 years is you have to always focus on the opportunities that are there as an investor. The people who focus in market on opportunities, they are the one who over a period of time end up actually compounding their wealth and creating wealth. The people who worry too much about challenges, yes, there will be challenges and it will create its own set of drawdowns. The people who focus too much on that, they always have difficulty actually staying put, because staying put is the most important thing in equity as asset class, because it will be volatile, there will be events, and it will lead to gyrations. One has to focus on what are the opportunities, and as he has set the context, there are a lot of opportunities. We always say that there are years which are actually years of actually reaping the benefits, and there are years which are the years of actually seeing the seeds. Our sense is, and I'm starting with the conclusion in a way, that calendar year 25, 24, 25, which is financial year 25, looks like a year where you have to sow the seeds, which means this is a year of investment rather than focusing too much on what returns you're getting. And I'd actually elaborate on this. Why do we think so? Okay. Broadly, when we actually explain the construct of market, we typically tend to use three or four buckets, okay, or broader pillars. One is what is happening globally and how it is impacting us. Second is how's the domestic macro shaping up, because ultimately why these two factors we discuss first and second is because we operate in a system. Ultimately corporates operate in a system. If the system itself is failed, then you have challenges. If system itself is doing well, then there are more opportunities than threats. Third is the corporate earnings growth, which is the basically holy grail of market. We believe that corporate earnings growth is something that is core to market. Uh, One has to be sensitive to what kind of corporate earnings that is playing out, because that's what defines ultimately what will happen to individual stock, what will happen to individual sector, and then what will happen to market. And lastly, the valuation and view context in terms of how are we summarizing this based on the valuation which is there in the market, and what is our view based on that. So that those are the four aspects that we will actually touch upon. I'll try to Abhishek, should I keep it more simple, should I keep it more technical, because I'm not very sure about the audience in terms of communication, so it will be very helpful if you tell me, should I go more technical or should I keep it a little more simple?
So you can keep it in a simple language because more of the
Okay,
customer they understand the layman language and the
okay,
technical term
okay,
also.
okay,
So
okay.
if we can elaborate the terminology, if any specific term is there, so that will be great for all our viewers.
Sure, sure, sure. So first is of course the global context. Why it is important is because over a period of time, the global integration of financial markets as well as the actual economies have only gone up. Thankfully for us, and this is where the opportunity is for India from this first bucket perspective. India is an inward-looking economy. India is a far more consumption economy. India has just 15% exports, so which means predominant part of Indian economy, what happens in terms of at least the economy, is internal than external. Having said that, the other factor is also very critical, that we are a commodity importer. So what happens globally impacts us. We are a large transaction partner with Europe and US, so it impacts us. What happens to global interest rate impacts us. And lastly, the most important is the foreigners hold almost 18-20% of Indian equity market in terms of FII holdings, which again, their behavior impacts us, and their behavior is a function of what is happening globally, also partly apart from what is happening locally. So those are the three, four aspects. So if I had to actually take it through one by one, the one factor clearly is and which has been the event that happened in just the month that passed by. Basically you have a change in the establishment in US, and this establishment of Mr. Trump clearly is more for two or three things. One, America first, which means they would want to actually have a lot of manufacturing as well as growth in America. They will give corporate tax benefits in US, which means America as an economy will probably relatively do better than what it was doing at the margin. At least that's the first leg of impression. Second factor is he is not so hawkish towards the fossil fuels, which is fossil fuels means oil, gas, coal, etc. Which means they are going to produce more oil even in US, oil and gas, which means there is going to be downward pressure on the commodities, particularly energy commodities, which is good for us as a country. And third, basically, is that you have him. in a leader who's in a way, in a very layman term, anti-war, which means one should expect these wars to subside at the margin. Of course, it's nobody, no one person can control it, but he will not be supportive of the policies that were there both on Ukraine side, Israel side, which means there will be some form of truce in both this, which is again energy positive. Why I'm actually alluding to this is because it is again energy positive. Just to put it in perspective, India imports 85% of energy requirement approximately. And if energy prices go down, it does benefit us. And if these wars actually come to an end, or there is a basically truce in these wars, then at the margin it helps. So these are the three things that are likely to be an outcome of an event that has happened just in last month. Having said that, it also had a basically counterbalancing thing that has happened, which is a challenge in a way, that the moment he came back, the anticipation is US will do well, which means the US growth will improve, which means the US inflation might not go down as much, and as a reaction, the bond yields have moved up, which is the interest rates in US have moved up, and as the interest rates have moved up, the flows are also moving back to US, which is the safe zone. You have in US projection of 10% of earnings growth, which means US is likely to do relatively better as compared to what the perception was just 2 months back, and which means there will be outflow from all emerging markets, and that's what we have experienced. So that's the one negative outcome in near term out of this change in the political establishment that has happened. So this is one fact of it, that there is an event which has happened. It has repercussions for several things. Just to summarize, you have a global environment where the inflation has come down, growth has also slowed down, but growth is stabilizing. In Europe, it remains weak. In China, our sense is the growth will remain weak. There will be a lot of noise around China, but our experience is, and we can learn from our own experience, India hardly had any debt in corporate side, but still just look at between calendar year 12, 13 and 20, what happened in India. Uh, Government kept talking, corporates kept talking, but nothing happened. Earnings CAGR was 9% CAGR. Okay. And why did that happen? Because everybody on corporate side and banking side and government side was focused on actually cutting cost, reducing balance sheet, actually, and ensuring that the system is deleveraging. That's where China is today. So irrespective of noise that you hear, and time to time there will be bounce backs in that market because it has just become absolutely cheap. But the growth on a sustained basis unlikely to come back given the aging profile or the demographics that is there in China. So the first, you have an environment where the growth from last 18 months has slowed down globally. China, Europe, in my view, remains challenging. US at the margin has stabilized at around 2.5% GDP growth rate. My sense is with Trump coming in, there will be a lot of expectation that this 2.5 goes to 3. I don't know whether it will happen or not, but that's the expectation. So, thankfully, we are in an environment where the interest rate cuts have happened. The interest rates have reduced from last year. The inflation has reduced from last year, and the growth has not suffered as much as it was anticipated earlier, which means you are clearly not going into recession. Okay, but that's an environment where you have the interest rates eventually going down, inflation eventually going down, which means eventually domestically also interest rates will go down by probably not much, but 50 basis point. But that's the environment in which we are operating in. So complex environment, but commodity positive for India, growth neutral for India, exports neutral for India, and flows negative from a near-term perspective, but constructive from medium-term perspective, given that ultimately wherever earnings is, wherever growth is, that's where the flows come back. So while as a first leg, everybody is selling all emerging markets. It's not only India which has been sold. China has been sold, US, India has been sold, Indonesia, Malaysia, Taiwan, Korea. You can think of any emerging market. All of them have been sold lately, and money has gone back to US. But as this first leg gets over, as actually the establishment comes back, people will again focus on where the growth is, and so flows will come back. But that's the environment in which we are operating. So we are fairly constructive that commodities will remain in check, growth will remain neutral, flows in near term will remain a little bit of a challenge, but will improve eventually. So that's the global context. Very, very complex, but improving in my view, because the one thing that clearly seems to be the agenda of the new establishment is focus on fossil fuel, reduce the wars, and that's both positive for growth, positive for India. So that's the global basically context. But just lastly, having said this, which only means that exports is not suddenly going to pick up. It is just that several sectors like IT, which will be beneficiary of what is happening if even 0.5% GDP growth rate increases or tax cuts, corporate tax cuts happen in US, it will be beneficiary for that. But for sectors which are commodity or commodity nature, uh, the environment will remain the way it has been, which is little challenging. So that's the first leg, first bucket, which is the what is happening globally in a simplified form. And at the end, you can ask question if there is any question on this. Uh, Neutral from our perspective and positive from commodity and defense perspective, in my view. So that's the first leg. Second is domestic macro. So domestic macro, people tend to complicate it. We always look at domestic macro from a very very simplified form. Okay, there are three or four buckets in domestic macro. Okay, what is happening to your external balances? External balance is very important, and it reflects in current account deficit in a very very simplified form, which means what is that you are selling to the world and what is this that you are buying from the world. The difference is, if it is negative, you have to pay it in dollars, so you need a lot of dollars. If you are surplus, you don't need dollars. Okay. Sorry. Most of the emerging markets are in deficit. We are also in deficit, but thankfully that deficit is very small, that is just 1%. So for financial year 25-26, and even for the year that has gone back, your external balance is likely to be in and around 1%, which is a very very good situation, which means anything happens globally, there will not be too much of a pressure, because you don't need a lot of funding in terms of dollar flows, because this is balanced by the flows that come on the FDI side, FII side, which helps you to actually balance this. Or okay, so that's one. Second is, thankfully, a lot of our exports are invisibles or export services. So tariff protection or tariffs will not impact us so much, because pharma and IT are the only two large exports that India as a country we do. And those are relatively more immune to some of these things that are happening in US. So external balance remains good. Second, India is a very, very inward looking economy, which I started with. We have just 15% of basically uh, exports. We have only 20% of debt, which is external. So again, we don't get impacted there. So that's the uh, external. That's where our currency has been one of the most stable currency over last 2 years. If you look at a lot of currencies for countries which are emerging markets, our currency has been fairly in a zone of 82 to 84. The reason is our external balances are extremely good and the energy prices are low. As I said earlier, also energy prices are likely to remain in a band below $75. Don't hold us for that, but most likely the outcome is likely to be like this, which means the external, your currency is not at a risk, huge risk, like a lot of emerging markets. So one reason for FII to sell in some of the economies is currency is at risk, which is not the case with us. So from external balance perspective, we are very very well positioned. Even from internal macro perspective, inflation is in check. Yes, it has gone up a little bit in last month because of food and all. Inflation is, core inflation is about 3.5%, which is very very good situation. WPI is under control. Your tax collections continue to be about 10-11% YTD, which is again very very healthy number. uh, the debt is largely domestic debt. The households are not very levered. The corporates and banks probably are in the best balance sheets that I have seen in my entire career. Not even in 2006-7 you would have this kind of balance sheet. Just to put it in perspective, the credit cost of banking system is almost virtually 0.2 0.3% today, which is lowest that we have seen ever. Same with corporates. The corporate operating cash flow, which means the cash flows that corporate generate annually, or last 4 years have been growing at up almost 17-18% CAGR, which is a very, very healthy sign. Okay. So, as I said, we explain the internal part in a very, very simplified form rather than getting into the complicated macro acronyms. You have a corporate balance sheet, private balance sheet, private in corporate India's balance sheet, which is extremely healthy. Okay. There is no debt on that. You have bank balance sheets, which is again extremely healthy. There is no large NPAs in that. You have government balance sheet, which is again good. They have done reforms, their tax revenues are growing well, and they're actually controlling fiscal deficit. And you have top 40, 50 crore or 60 crore population of country, where again the balance sheets are extremely good. So these are four buckets. And then you have exports, which is relatively weak today. But these are the four buckets in which the economy operates, and most of those buckets are either neutral or actually positive. The only bucket in the domestic macro which still remains weak is the mass consumption. And why mass consumption is weak is predominantly because those 70 crore people, which I did not count in the first leg, those are the people where the job creation is not as fast. One. Second, they suffered during COVID. They suffered because of inflation. So, and also, if you look at government over last 7, 8 years, 10 years, at least the central government's rural spending was lower than the capital spending. Government did a very, very good job of actually spending money on the investment side, infrastructure side, roads, railways, defense, airports, ports, irrigation, but they did not spend as much. And that is also because government has only so much of money, so it has to choose where to spend. Last 10 years, they chose to spend a lot more money on roads, railways, and infrastructure creation because that creates job, that creates more velocity in the economy as compared to rural spending. But with after the general election and with the state election, what we are seeing is that that populism is back, and to that extent, we are at the margin of becoming more constructive on consumption because now you have almost 12, 13 states put together spending almost 2.5 lakh crore rupees annually on some of these schemes like what you have seen in Maharashtra Ladki Bahin Yojana, which is basically giving 1,500 rupees per head, per woman, per month. Those kind of schemes have been done by Maharashtra, MP, and Haryana. Every state is doing it now with the elections, which is in a way good counterbalance now with what was happening for last several years, whereby we were not helping the 60, 70, 80 crore people who are really at a lower level, and that's what was hurting the mass consumption or rural part of the economy. That's getting some help in terms of two 1.5 to 2.5 lakh crore rupees now annually from state governments, which will actually help that bucket to also kind of come in a relatively better zone. I'm not saying out absolutely better zone, but relatively better zone. So that's the domestic macro. Again, kind of neutral. The one thing that we keep actually highlighting in every interaction that we have with all investors, whether it is a retail investor, whether it is a HNI investor, or whether it is an institutional investor, is that in any economy, when you have strong balance sheets, very unlikely that you will get large market corrections, okay, or basically long market corrections. And the fundamental reason behind that is if those with those kind of balance sheets, more or less after few quarters the earnings will come back, okay, because the corporates are going to expand balance sheet. Private capex is likely to only pick up from here. Real estate cycle is already gradually picking up, and mass consumption is also eventually will come back, and urban consumption or affluent consumption anyways is good, okay. So your earnings will come back, which has taken a little bit of a breather, because of which you are seeing some volatility in market. So that's the second piece. Third piece is clearly in terms of basically what is happening to corporate earnings. And that's just to put it in context before actually going to what happened this year. Let me put some numbers. Okay. For last 5 years, financial year 19 to financial year 24, the earnings growth was 18% CAGR. Okay. For BSE 200, which means the earnings were very, very healthy. Okay. Within that, it was not 18% every year. There was a year which was financial year 22, which was a sub 10% earnings year, which means earnings inherently are likely to be little volatile. But as long as you are in a broader economic cycle whereby banks balance sheet, corporate balance sheet, household balance sheets, or government balance sheets are not challenged, your earnings will come back with a lag. Okay, and that's what we are seeing this year. First half we have taken a breather. First half earnings growth is sub 10% again, okay, for BSE 500. uh, Whereas the expectations were 12 to 14% earnings growth. Probably you will end up somewhere between 6 to 9% earnings growth for the financial year 25 as a whole. And why it is happening? It is happening for two or three reasons. Reason number one, you have basically had an election, okay, in the first quarter. During election, government capex tend to actually slow down. That was the reason number one. Reason number two, you have actually a year where the rainfall in at least 5 to 6 states was anywhere between 30 to 80% higher than the averages, which impacts your economic activity significantly. For example, there are two states in south where there was so much of rains that the companies who are actually specifically concentrated in those two states have actually shown negative growth in this quarter. Okay, so that's reason number two. And reason number three is basically the statistical reason, whereby as the commodities have corrected, there are several commodity segments, particularly oil and gas and metals, there the earnings growth decline was as high as 50 to 80% in some of the companies. Okay, and at aggregate level also probably 50%, which has pulled down the averages. So if you adjust for the third factor, your earnings growth is still 10% in India, which is not so bad. Okay, these are the three reasons because of which you have seen a contextual slowdown in the earnings. Our sense is in second half. Okay, and fourthly, actually, you had Shraddh and weddings. Okay, which have fallen in different, basically in terms of different months, in terms of calendars. For example, this year was the lowest wedding days in India in last several years, probably 20 years in first half. And weddings is a very, very large market. Again, it impacts everything, right? From auto to apparel to everything. Okay. So these are the three, four reasons which have led to contextual earnings slowdown. Yes, earnings will still remain a little bit of weaker than what was anticipated, predominantly because of commodity energy, because government capex might not actually be completed at 11 lakh crore rupees this year, and you don't have any margin benefit this year, unlike last year. Last year we had 30% earnings growth, so earnings is moderating this year. Is it a worry? Contextually it is a worry, contextually, which means that you are going to see some slowdown. But should one get worried from a 3 year perspective? Our sense is still from a 3 year perspective, you should still experience with the consensus number that is there, which is 12 to 13% earnings CAGR over next 3 years, barring financial year 25. And why it is likely to happen? Because still in the economic cycle, you had only seen one part. Okay, we have seen the public capex, which means government capex has happened. Next leg will be corporate capex. Then you will have real estate full-fledged cycle, and then you have full-fledged consumption cycle. We are yet probably in the middle of the cycle, not towards the end of the cycle. There is no balance sheet challenges. Okay, and when balance sheet challenges are not there, as I said earlier, people don't get worried when the balance sheets are not challenged in market as an institutional investor. If balance sheet is a challenge, which means if the corporates are levered means debt to equity in a very, very simple form, which means how much is your net worth, how much are your cash flows, against which what do you owe to banks, borrowing कितना है आपका. अगर borrowing बहुत ज्यादा है तो उस वक्त मार्केट में बड़ा प्रॉब्लम हो सकता है. इस वक्त इकोनॉमी में वो कोई भी चैलेंज नहीं है. चैलेंज सिर्फ ये है कि इकोनॉमिक एक्टिविटी थोड़ा कॉन्टेक्चुअली स्लो डाउन हुआ है, और हमारे हिसाब से वो धीरे धीरे करके इट विल गो अप ग्रेजुअली. So that's the context of earnings. So consensus earnings is still expected to be about 12 to 14% for financial year 26 and 27. Financial year 25, which is the current financial year, is likely to be a single digit earnings year. So that's the earnings context. Not so great from near term perspective, but still relatively far healthy from a medium term perspective. Okay, and lastly, is the last bucket, which is the valuation and view. This is where people have to digest and actually look at equity market as it should be. Okay, last year because the earnings growth was superior and there was a lot of liquidity, particularly from domestic side, and I should actually give you some numbers. Last year, Indian retail investors put in something like $35 billion in Indian market. Okay, this year in 9 months, 10 months, 10 or 11 months. Now we'll complete 11 months today, but we have just numbers for 10 months. In 10 months, Indian investors have put in 55, almost 50 to $55 billion of money in the Indian market. And that's what is, and it is a function of what has happened last year in terms of earnings growth. People thought that this is the earnings growth. So with that kind of liquidity, you have taken the valuations up than the historical levels. Okay. Just to put it in numbers, the valuations for large cap are in a fair zone. Okay, largely. Last 10-year Nifty 1 year forward price to earnings ratio was about 18 and a half times. Today we are trading at roughly 19 and a half times, which is 5-7% higher than the historical level, which means large caps are in a fair zone. And why has it happened? Because the money has not come in that category. One. Second, FIs have consistently been seller. Not that there is something terribly wrong with it, but there is a technical reason. And on top of that, of course, earnings was weaker than mid cap, small cap last year, but more because of technical. Second is mid caps are trading at something like 27, 28 times 1 year forward earnings. Okay, and small caps are trading at 25, 26 times 1 year forward earnings. Both mid cap and small cap are trading at least 25 to 30% higher than the historical valuation. Part of it is justified because we are in an economic up cycle. So mid cap, small caps tend to benefit because there are arbitrage on economic activity. So when economic activity is better, their spreads are better, their earnings are better than the large caps. But so much of premium is almost unjustified, and that's where the market, as the earnings are falling short of expectation, as the earnings will fall short of expectation, because to justify 30 times or 25 times, you need almost upwards of 20, 18, 20% earnings growth. We think that it is a arduous task, at least in our humble view. Uh, it's a very, very low probability event, and that's where you are going to see consolidation of market. Okay, you have to digest the valuation and extra return that investors have made last year, which means the valuations have to adjust for the reality rather than the liquidity that was coming in. And as that happens, you will see the consolidation of market, just like what you saw in calendar year 22. Calendar year 22 whole year, market did not go anywhere. It had a lot of volatility, but market did not go anywhere. But again, the reason was earnings were actually single digit in that year. Our sense is, while your medium term view remains extremely constructive, You are in a very, very constructive zone from economic perspective. You are in a very, very strong balance sheets from economic perspective. The government capex and private capex is likely to only, particularly private capex is only likely to accelerate from here. Okay, the real estate cycle is only likely to accelerate from here, in our humble view. But with all those things, we're still likely to have a financial year 25, which is likely to be fairly subdued. And on top of that, you had upfronting of return that has happened last year. Just to put it in perspective, last 1.5 year, you have investors have made 50-60% return in most of the categories. Okay, so you have to digest those valuations and adjust to the reality of what is the base earnings that is possible over a period of time. And the base earnings is likely to be 12 to 14%. And to that extent, you have to give up those return, not necessarily in terms of price correction. Had the balance sheets been challenged, you would have seen a huge price correction. But since the balance sheet is not a challenge and you are in the mid cycle, you'll only see the time correction in our view, which is what you have seen, 5-7% correction. Then market will go sideways. Then again, you will go up. Then again, so this is, that's where I started. I said, when I said am starting with conclusion, this is a year of actually sowing your investment. This is a year of actually allocation, rather than expecting a lot of return. If you get returns, you should be happy. If you don't get return, just focus on your process, which is actually keep allocating, so that you benefit next year, when the next and next to next year or next to next year, when the earnings start actually flowing in at a relatively stronger basis. So that's how we are looking at the market. So from that perspective, relatively more constructive on the large cap, flexi, large plus mid, consumption, hybrid kind of strategies, aggressive hybrid kind of strategies, BAF kind of strategy, and only constructive for investors who have 5 year horizon, and SIP for mid cap and small cap, multi cap funds. So that's how I'm summarizing. This is not uh, a recommendation to buy or sell of any of these funds or stocks, but just how we are seeing market, where the earnings are, where the returns are, where the expectations are, and where the valuations are, the context of that. So I think that concludes almost my 30. I thought of 30, completing it 30 minutes. I just took 33 minutes. So, but I have completed almost everything that I was intending to speak. So I'll stop here and then we can take questions if there are any. Thanks.
Sure. So thank you so much, Mr. Shridatta, for your valuable insights to our all the audience. What you have put it over there. You talked about the completely market outlook, the equity scenario, what we are looking into, whether it's about the banking policy or the cutoff rates, the balance sheet, overall exposure and potential in coming weeks. So even in terms of the respective category as well, the large cap, large and mid cap competition, flexi cap, and the SIP, the potential of SIP returns, and especially the major point you have mentioned, that no one has to worry because it's just about the whatever strategy you have followed. If the things are not working, so you just have to wait and watch. And once the things will be in line as per your, then your strategy will come up with the in terms of returns, and definitely you are going to get the returns. So that is something good. So, Shridatta, we are having a few questions from our viewers. So, on behalf of them, I would like to ask you. So, one question is related to market volatility. So, given the current global economic uncertainties, how do you see market volatility impacting the equity market in the short term? Means, what should investor keep in mind during these volatile times?
So, so it's a, on a lighter note, it's a very funny question, because when there was no complex global environment, the complexities of different nature, correct? If you just look at last 5 year, 18, 19, we had actually the balance sheet, US balance sheet rewinding scare. Then we had COVID. Okay. Then we had inflation scare. I mean, the inflation that we had not seen in last 30, 40 years, you saw that. Okay. Then we have two wars. Okay. Which all of, at least Ukraine, Russia, I can tell you that we didn't think that they will go on war. Okay. You had two wars. You had so many uh, translation transitions in politics from center to left parties to right wing parties across the globe. Okay, so the global complexity and volatility is here to stay. You have seen oil at $110 and now at 60, $65 and now at $75. So this is here to stay. Okay, uh, yes, this volatility can impact you, but incrementally, what is happening, as I alluded at the start, we see the global volatility going down, and this is just based on the conjecture that we are making, that what is the stated policy of the new US president, what it means for the Israel war and the Ukraine-Russia war, uh, and what does it mean for the oil prices, commodity prices. All those things actually tell you that it is more likely to be positive from a fundamental perspective rather than negative. Yes, the only negative thing from a short-term perspective, which also I alluded to, is that when US is relatively doing well, when US has 10% earnings growth, and in US in debt you are getting 5% yield on 10-year GSEC, why should you go to any emerging market? And that's where you'll see at the margin emerging market flows being reverse, and which is what you are experiencing already. I'm not telling you something new. You have seen already for last 1.5 months that this is the quickest $12 billion pull out from India, that 12-13 billion dollar pull out that we have seen in India. And this is not only for India. This is nothing specific to India. Even from China at that valuation also people have pulled out money. Okay, I was just reading a report just before coming to this meeting. In a single month, all emerging markets put together have experienced some $15 billion of pull out, and that has gone to US. US has received $47 billion from all emerging markets plus developed markets put together. So it's just a contextual. So that's the only thing that is likely to create volatility. Second is more domestic, and that's what investors should always focus on. Is our economy doing well? Are there balance sheet challenges? And how is the corporate earnings play out? Ultimately, stock price and market is only and only a function of what is happening to underlying corporate profit growth. अगर corporate profit growth नहीं आया तो कितना भी liquidity आ जाए domestic में market नहीं चलेगा. जैसे money is coming in market, correct, but still the market has not gone up in last 1 month because the earnings have been weaker. Okay, and when earnings come, the liquidity will find its way, whether it is local liquidity or global liquidity. People will come finding you that there is a growth in this economy, in this sector, in this company. It's just like what we do for companies or what we do for sectors. That's what investors do for countries and geographies. So if your earnings growth picks up, all this volatility will be gone. But yes, in near term, given the valuation context and given the outflows, particularly towards US, we see this volatility remaining here, and that's an opportunity. You look at it, this is an opportunity because uh, these things keep happening. I mean, I've been in market for 18 years, and I don't remember a single year where you don't have some or the other aspect to discuss.
Correctly said, Shridatta. So we have another question in terms of this sector opportunities. Which sectors or industries do you believe are the most promising in current environment, and where do you see potential risk for investors, especially in
So I
this
think
volatile?
from a sectoral perspective, I think after a lot of underperformance, large lenders or large banks is one space where we see opportunity. The entire consumption basket, I think, is an opportunity. Okay, right from FMCG to consumer durable to consumer retail, from a 18 to 24 months perspective. Uh, Industrials, I think, is a whole cycle. You are in the middle cycle. So, yes, there's a valuation challenge there, but I don't see earnings as a challenge in that back. Hotels, hospitals, telecom, aviation, these are the spaces where we think that uh, the underlying growth dynamics or growth valuation combination dynamics is more positive than negative. Then you have spaces on top of that. Actually, IT will also at the margin likely to benefit now with given what is at least expected from US. The other side, you have basically uh, commodities, all global commodities, whether it is metals or chemicals. Uh, you have domestic commodities versus or listed entities, which is energy space. Uh, we are not very optimistic around these, particularly these two spaces. So, metal, commodity, energy. These are the spaces where I think incrementally what is happening globally is more negative because it puts pressure on the prices ultimately, and growth is not picking up. So, if growth is not good, which means demand is not good, and you have more and more supply which is likely to come in, so these spaces can remain challenging. So, that's I think those are the two spaces we see as a challenge. As I said earlier, and this is generic, of course, there will be opportunities and there will be threats. But in mid cap and small cap, over next 18-24 months, wherever people are paying disproportionate valuation for very average businesses, and there is no specific sector in this, weaker businesses across these spaces, as the growth normalizes, people will realize that they were not as good business as people thought last year. Okay, and if you have paid 40 times, 50 times, or 30 times to a business which deserves 15p, then you can have a lot of pain. It might not come in one day, but it will come over 24 months. So that is another space where we see people need to be a little more cautious in terms of actually uh, uh, from a not from sectoral perspective, but from a asset class perspective, people should be a little more careful about there where they are investing there.
Sure.
Because, and I alluded to the last factor, because last and a lot of people, retail investors have told me this, not anybody else, or IFAs have told us, sir, आप लोगों को नहीं समझ में आ रहा है, okay,
Mhm.
last year. Probably next 18 months we will have time to tell them back that you आप लोगों को नहीं समझ में आ रहा था. So it is just the context, because a lot of weaker businesses have gotten to a valuation multiple which is not necessarily very sustainable in our view.
Sure. One more question already. You addressed this question, but in a short case, if you want to suggest that for the long-term investors, how should they navigate the current market condition? Means, should they stay invested with their existing investment or consider rebalancing their portfolio?
Sure. I think the first is you have to consult your own advisors. We are not advisors. We are manufacturers of product. With this caveat, I think one should look at their allocations, how their large cap, mid cap, small cap hybrid allocations are, and they need to, they should resegate based on their advisors' kind of suggestions. From a risk reward perspective, clearly, actually moving a little bit more towards conservative categories might not hurt. That's our sense. That's one. Second, yes, incrementally you keep allocating, and that's again why I said at the start that you should consult your advisor. If somebody is 80% in equities, for him the advice would be very different than somebody who's in 5% in equity. But generally, I'm just using a number. If you're out of your all savings, only 10-15% are going into equities, then don't bother about worrying too much about these things. Just keep doing your SIPs or keep allocating based on a pattern, based on your goals that you have over a medium term. Don't worry about the volatility in market. The more you look at this volatility, more is the probability that you will pull back, looking at the near term, and which we keep saying that, and that is a psychological challenge we also face because we are very close to market. Is that the more you look at near term, the more exaggerated it looks, and the challenges look overestimated, and the benefits that can come in long term actually look so understated when you actually look at near term. And that's where people need to actually balance this in terms of the allocation. So keep doing allocation. I think yes, this year you might get further opportunities, but it looks like a year where you need to allocate. I would be very happy. It will be a happy surprise if you make a lot of returns this year.
Sure. One more thing, especially in terms of the investment mode, because now a condition to market volatility, most of the people are preferring investment mode as SIP and STP doing. So, what do you suggest? SIP and STP mode ही बेहतर option होगा, or we can go with the lump sum
See,
option as well.
anybody here who already has a sizable, I think, part of their net worth in equities, the SIP is the best mode. If somebody is starting off, I think he can actually go a little more constructively, more aggressively, and start with 20-30% and then allocate. I mean, but this is, I think everybody should consult their advisors because we are not the advisors. We are more manufacturers of product.
Okay, got it. Your point. So, one last question for all our viewers: that any advice from your end for the new investors, not for the existing one.
Oh, for the
Anything
new
you want to
investors, only two advices. Don't get carried away. What you saw last year is not the normal return that you'll get over a period of time. And if you don't want to learn it in a hard way, please be very careful about where you are investing in terms of direct investment. Okay. Because most of the people have replaced fund managers now and they're going direct. Well, we are not saying this because we have business, but it can be very, very risky when the market turns. So be very, very careful. If you have research capabilities and if you have bandwidth and if you are in business and spending time on research, then by all means you should do it. But if not, then be very, very careful about directly going to equity. That is one. And second, as I said, I mean, just focus on your medium term goals in terms of what are your objectives, how much wealth you want to create, and if that wealth at 10-12% CAGR needs a particular kind of SIP, don't listen to a lot of fund managers, including us. Okay, just keep doing what you're doing. Don't look at too much of CNBC or anything. Just keep doing it, because ultimately market is just a function of earnings. Thankfully, we are in a part of world where growth is abundantly available. Just to put it in numbers, India's nominal GDP growth rate over the last 17 years has been in between 9 and 11%. And corporates add to it, which means that there are every 3-year bucket, you have 100 corporates who are growing their earnings at 15%, which means opportunity is abundantly available. So stay put, keep allocating. and keep focusing on your goal rather than actually focusing on near-term volatility, whether it is macro volatility or micro volatility.
Right. Thank you, Mr. Shridatta. So you nicely answered all the questions, and the topic you have covered is equity market outlook very nicely in a layman language for all our viewers and the investors. So on behalf of all our viewers and Bajaj Finance Limited, I would like to thank Mr. Shridatta for being with us today and sharing a detailed, comprehensive view and insights on the equity market outlook. I'm
Thank
confident
you,
that
Abhishek,
this
for this opportunity from Bajaj Finance.
sure. I'm confident that this insightful session, especially in today's market, will be extremely helpful for all our investors in making an informed investment decision. And for all the viewers, for more details about the available funds, I encourage you to download the Bajaj Finserv app from the Play Store and visit the mutual fund section. Alternatively, you can also visit the mutual fund section on our website, that is www.bajajfinserv.in, and can start investing via SIP or lump sum or STP, whatever comfortable to you. So once again, thank you to all the viewers, and especially thanks to Mr. Shridatta for your valuable time and insightful contribution to today's session.
Thank you. Thank you.
Thank you. Thank you so much.